Hey everyone, Austin with the Johnson team here. I know not everyone keeps up with the Federal Reserve meetings or economic policy. I don't know. I hear my friends ask me questions about it because they see it in the news and they wonder what's going on. So I wanted to take a minute just to explain what happened in that FOMC meeting yesterday. I'm going to break things down. I'm going to try to keep it simple, explain it to you in a practical way, just because I am looking at this pretty much every day and keeping an eye on it. Let's talk about how it affects your money, your mortgages, what's going to do to the housing market. We're going to talk about the quarter point rate cut. We're going to talk about the return of quantitative easing and what the Fed wants in 2026, whether actions don't always match what they say, and what the recent Realtor.com forecasts, how they just might not tell the full story. So what did the Fed do yesterday? The Fed cut the rates a quarter point. This continues a slow pace of easing. It also began stepping back into the market by buying short-term treasuries. They say that this is meant to support liquidity and stabilize short-term funding markets and keep money flowing smoothly between the banks. Some analysts view it as a light form of quantitative easing, although the Fed is planning to buy roughly $40 billion a month. This is significant enough that many people question whether or not this should be considered light at all. Large-scale asset purchases like this, they increase the amount of money circulating in the entire financial system. So when more money chases the same amount of goods and services, inflation often follows. In simple terms, they lowered the rates again and they started adding more money into the system. What the Fed says versus what the Fed actually does. The Fed continues to say that inflation is under control and that they intend to keep rates low into 2026. However, their recent decisions kind of tell a different story. Cutting rates again and adding $40 billion a month into the system increases liquidity, and in that environment, it usually supports inflation rather than cooling it. This suggests that the Fed is giving more weight to its employment mandate than it is to its inflation mandate. In other words, they want to protect the job market, even if doing so risks inflation again. This is why the messaging is inconsistent. The Fed talks confidently about how they want to lower rates, but their actions create conditions where inflation is more likely to stay elevated or even increase. So let's talk about the Fed's mandates, right? Where does housing come in? To answer that, we need to look at what the Federal Reserve actually is required to do. The Fed has two mandates from Congress: keep inflation stable, support maximum employment. That's it. That's their entire job description. Nothing in their mandate focuses on housing. They don't have a responsibility to keep home prices affordable or to control mortgage rates. Those changes are simply side effects of the broader economic decisions that they make. Once you understand this, that the Fed's behavior makes way more sense. When the Fed leans more heavily on the employment side of its mandate, policy tends to become more supportive and more money flows into the economic system. This helps jobs, but it also increases the risk of higher inflation. So let's talk about Realtor.com's forecast from last week. Realtor.com expects home prices to rise about 2% next year. Rates, they're probably going to average 6.3. So it's about the same, maybe a little lower than it was this past year. If you have a $500,000 house, odds are it's probably going to be maybe worth about $510 according to that projection by the end of next year. But their forecast may not line up with what's actually going on according to the Fed. If the Fed is adding liquidity and lowering rates, the inflation remains sticky. That environment tends to push asset prices higher, and housing is one of the most sensitive assets to inflation. This means home prices could rise more than the projected 2%. If inflation increases, housing often responds quickly because it's a real asset, and I believe the Realtor.com forecast may be a little too conservative. And it may be a reason you want to consider buying more assets before this inflation gets here. So this is what it means for regular people. Here's what I want to say clearly to my friends who don't follow this stuff every day. If the Fed continues to favor job stability over strict inflation control, we could see more price pressure across the economy. Your purchasing power could decline while real assets increase in value because they're a hedge against inflation. When rates drop and more money enters the system, inflation often rises. When inflation rises, assets that hold real value usually increase as well. These things include homes, investment properties, stocks, gold and commodities, hard goods, collectibles, things like that. In my personal opinion, we may be entering a window where buying assets is a smart long-term move to protect against another round of inflation. If the Fed continues prioritizing jobs and liquidity, the value of real assets usually climbs in that environment. This is not about timing the market. It's about understanding the direction in which the economy is moving. So here's my conclusion. The Fed is cutting rates, they're adding liquidity, and they're signaling caution on inflation. Realtor.com forecasts modest home price growth, but larger economic environment could support stronger appreciation than they're expecting. If you want to talk more about buying a home or investment property or other assets that you may want to buy, gold and stuff like that, like reach out to me. Like, let's talk about it. The time might not be right for you, but I really like geeking out on all this stuff and having conversations about it. So I'd love to hear your thoughts, especially if you do pay attention to this kind of thing. And let's have a conversation. So reach out to me here. Most of you have my cell phone number, so call me, text me. Let's talk about it. Y'all have a good day.